Larry, was the action today in bonds just a little relief after incessant buying, or did the market really take something from Powell's language and apply it to their December cut thesis?
No, I think it just speaks to how far ahead of the Fedspeak the market had gotten, exasperated by the stock market sell-off. And so at this point you have you have Powell speaking today on that inflation conference and mentioning the fact that they'll do what they have to do, and I think that's better than a surprise rate cut, and the market just adjusted, knowing it's in a severely overbought area right now.
So, Larry, what did Powell do to really confirm or deny that? My narrative here has been basically, it seems like he thread this needle where he didn't confirm that they're going to have to cut, but he used this language of acting to sustain economic trajectory if needed and stability. But then you had Clarida right afterwards basically go, market, give me a break. We're not going to cut just because you want us to.
Yeah, no, I think it's one of those things where a rate cut is just, it's on the horizon. I mean, I think that's how I interpreted it. We already know that the market has a preemptive rate cut built in, and that's very telling for the next leg in the rate market, because if the Fed doesn't follow through, I firmly believe it will be risk off. So reading through what he said today, definitely we're seeing a rate cut on the horizon.
All right, now the chances coming into this for the December move now are basically kind of the same from where they were. The markets haven't adjusted too much. I'm not sure what the Fed Watch tool shows, but there doesn't seem to have been a big shift in terms of the expectations for this year based on the information from Powell today. Am I right?
Yeah, I think you are right, except I'm looking at the 3-month, 10-year, and that's what the Fed models use. And right now, still at a negative 20 basis points, according to the Cleveland Federal Reserve model that they use. And with that in view, that would imply a 40% chance of recession over the next 6 to 12 months. And it's a model's as good as what's written in it, and this every time is different. But it worked perfectly in 2000 and 2006. But again, every time is different, and history doesn't always have to repeat itself.
So, Larry, the last thing here, that I think is important for the stock market. It seems a clear answer, as you and I have discussed before, where the Fed getting in line with the expectations for a cut is probably going to be pretty important for stocks. And we see green across the board today with this delivery from Powell. That said, for bonds, to me, the question still remains open. Are these signs really pointing towards investors as viewing a recession imminent without cuts? Meaning that if the Fed signals they are going to cut, then maybe there's a way we can envision that as actually being, bond price negative and yield positive, right? Which is what we got today. But do we know if that lasts, right? Because Fed funds futures basically tell us the chances didn't really change. So should we believe the response to Powell?
Yeah, no, you can, and I think it's much better for the market than what most people were expecting, and that was language that would warrant a surprise cut. They're on it, and it seems like a rate cut is imminent. I mean, June, June's off the table. It would take 9 out of 11 people to lower that June dot of 2.40. I think that would be very, very hard to do. But December is definitely on the table, and I think the market's already done the preemptive cut for him. And so with that in mind, it'll make it a lot easier, and I think it's healthier for the macro trading, whether it be the U.S. dollar, the stock market, or rates.
All right. So if this is the first step for the Fed, obliging the market's wishes, is it time to get short bonds again, Larry?
Well, good question. I think I would give it a few days. I mean, I think the support and resistance levels are so far apart right now, it's hard to make a case for either way. I would say that the old 260 is now 240, and the old 240 is now 225. And what you have to ask yourself is that if we close the year of 2019 above 225, or even really above 240, that would say, at least to me, that the FOMC was able to get in front of any kind of recessionary headwind. Other than that, it'd be really hard to make a case now, the way things stand, to get us too much above 2.40 at year end.